It's all yours, Wes.
All right. Hello, everyone, and welcome to another month of our investment business daily meetup group. Thanks to everyone for taking some time to visit with us this evening. We're going to talk a little bit about the bear market that we now find ourselves in, and what's fueling it. Of course, tariffs, a lot of tariff talk, and I'm going to go through and of course, Roy and our focus is always on the markets and what we're seeing and trying to we're basically just going to give you a temperature of the market, knowing that we're oversold, knowing that sentiment's very bad. But you'll also recall we talked about this last month, a very similar type of setup, right? Sentiment was really bad. We were oversold, but we keep staying oversold, and the news flow has gotten worse with this tariff stuff. So we're going to focus on the market. If you were with us just a couple minutes ago, one of our guests, Scott, he was giving us some insight on the tariffs. I'm sure, we'd love to hear from you guys at the end of this too, just a little bit to hear about your input on what it might mean for your business. If you can share any insight, I think that's, useful for us because it helps people understand the reality of it and what it means for, and always for us, what it means for the market. It just helps to have that anecdotal info to understand. But with that, we'll move forward, and I'll let you guys or introduce ourselves a little bit more. I'm sure a lot of you have been here before, but here's what we're about. We are a group of investors who are originally based in Charlotte, North Carolina, and we focus on technicals and fundamentals for the stock market. We um, ground a lot of our thinking in this book, How to Make Money in Stocks by William O'Neill, and his company, Investors Business Daily. They have a lot of educational support and different resources that we use that are extremely valuable for us as traders. And we find that a lot of the fundamentals in that book are extremely helpful for us for as traders. We'll talk about CANSLIM. That's a big acronym that he coined several decades ago, and that talks about the fundamentals. But we're here to just educate and talk about the market, and we'll talk about how we see things as they are currently. And just as a disclaimer, this content is just for it's not a recommendation to do anything necessarily, right? So we're just here to give our opinions and try to educate and discuss things with you guys. And so I mentioned this for background. We talked about that CANSLIM acronym real quick. That's this fundamental kind of acronym and how to make money in stocks. And these are the key things that William O'Neill found were, the most important when determining, which stocks to buy. So you're looking at currently quarterly earnings growth. You're looking at annual earnings growth. You're looking for companies that have something new. So maybe it's a new product or service or an industry change, new management, or just in general, new price highs in the stock. That's, super important for us. Supply and demand. So there's some volume cues that we're always looking for. Um, you want to buy the number one stock in the industry, not the laggard for the catch-up play. Something that might be like Nvidia, for instance, over AMD. That was a clear instance of leader versus laggard. Maybe it's Kava versus McDonald's or something in the restaurant industry or whatever it might be. But buy the leader, not the secondary name. Institutional sponsorship. There's a lot of retail volume out there, but really what moves money is institutions. Those are the guys that are running hundreds of billions of dollars and really leave their footprint on a stock when they're buying it. They can't really hide. They have to pile in when they see a good opportunity because they're buying this thing for the next several years. Oh, and then market direction. We'll talk about how the market direction changed for us, how we view that, and when it changed, and how it kind of kept us out, at least kept us hesitant. I know we tried a couple little buys, um, maybe one day in this whole downtrend, and just got out quickly. But the market direction is what tells you to stay out, and that's kept us out for some time. And so generally, this is kind of how we talk about our three pillars of decision making and investment strategy. Technical analysis being number one, I think, then fundamentals, and then macro. A lot of macroeconomists come out during bear markets because everyone wants to justify exactly what's going on, and it's interesting to understand it and determine it, and if you've seen it enough times, been a spectator and lived through things like that, I guess you kind of understand the parallels, which is nice. And we'll talk a little bit about that today, a little bit about macro. But technical, really, that's our most important thing. We're talking about price, we're talking about momentum and trend and things like that. And then other things that fall into technical analysis often are sentiment and breadth. We'll look at that. Two of the key things that we're looking at for a good durable bottom to be in. It's anyone's guess, but that's the problem right now. It feels like a guess. And you could have been guessing the last 3 days, and it's been extremely volatile intraday if you've been sitting in front of the screen, watching it. So it's very unclear, and maybe we'll talk a little bit about treasuries too. I thought treasuries were very interesting the last 2 days, but and just a lot of different things on this list we'll get into further along. And then, we already talked about the CANSLIM acronym, but this is the fundamental pillar, the fundamental analysis. So this is kind of a key summary slide of what we're looking at whenever those stocks do so. We've got a short list right now. The list is really zero, but if we're stretching, we could say 5 to 10 maybe that we're probably all looking at too, which is part of the problem. It's a very narrow list of stocks that are holding up. So anyways, we may talk about a few, but in reality, in a bull market, nothing's really, or in a bear market, nothing's safe, including gold. Roy and I have been talking about gold a little bit and thinking to ourselves that they're going to come for it, just like they do in any kind of nasty bear market. So we'll just sum up. A lot of stuff that you guys have probably already recognized and seen, but we'll talk about it in case you missed it. This is something we've been looking at ever since this day, right where it collapsed, and something was flagging to this model that we're going into a recession. That was February 24th or something when they adjusted that down, and coincidentally, that might have been the last day that we were in the market. Really, as we were trimming. I know that we ended up selling a lot of stuff the day after earnings for Nvidia. That was a Thursday, I believe, and I think that was a coincident with this model having a major shock to it as well. But this is telling you, recessionary numbers for Q1. Q1's behind us. It'll be interesting to see where Q2 comes in, but I think as Scott, one of our members, mentioned it earlier, he's putting on the brakes. Other people he's talking to, are putting on the brakes, because what you do, and what me and Roy have been discussing, is you just wait, right? And so whenever you freeze, that is recessionary in itself. So I think that's unfortunately what a lot of psychology would do for anyone, right? Where you're expecting these tariffs to be lifted, and so Q1 we've gotten through with this recessionary number. Q2, if everyone behaves like it sounds like they are about to be or are behaving, Q2 is probably geared up to have another decline in GDP, and again, that's like the definition of a recession, but we may see that 2 quarters of negative growth here. I don't know if anyone has seen this, but there's this gold adjusted GDP now. Apparently, there's a major import surge of gold into our country or something like that, and that's why that's weighing down on this model quite a bit too. I don't think it really matters. I think it's still quite negative. But anyways, I'm very interested to see where Q2 is shaping up as far as that model goes. They updated this last April 4th. I'm not sure when the next one comes out, but because really we don't care about the backward looking number. But it was interesting that it told us this. It told us this very quickly out of nowhere, so it's the main thing I actually watch for GDP growth in the quarter. So this is what sparked the fears. This is that big chart or that big table. If you saw Trump in the Rose Garden, he pulled out a big table and he was pointing at all the, top numbers. And at 401 is when he started his speech. He mentioned a 10% tariff. The market went up 1%. By 405 or something, 410, I think he had brought out this table and the market reversed and was down like 4% um, after that. So, here's what we're dealing with, of course. These numbers have changed. I know China's gone up. Um, I don't know. I don't exactly know where they are, but if you would also figure out how they calculated these, this is what's kind of strange too, and what's been jarring markets as well is the fact that we don't really understand what we're doing here. It's not exactly reciprocal. It's not a tit for tat thing. It's just a widespread tax um, on all these countries that we import from. It's just a kind of it's somewhat arbitrary, but they do have the math if you look it up to how they came to it, but that's somewhat strange. They're much higher than I guess everyone expected, clearly. Um, so they're sweeping, they're high, and it's everyone still expects some negotiating, but we will see. And just here's the chart when these reciprocal tariffs were announced. It was that evening when the market closed up, and people had had higher hopes for a friendly type of reciprocal tariff. We did not get that clearly, but since then it's been a plunge from that little rebound, and that has put I think the S&P officially was in a bear market at these lows, down 20% from the highs. The Nasdaq was probably down 20, I forget, 28% or 26% from the highs, um, and still remains down, more than 20%. So that's the action we saw. We like to just kind of look at this too. This is that IBD mutual fund index just to see, compare performance. You can consider how you're doing versus some of these top mutual funds in the world. This is their, top 20 mutual funds in the world and how they have done. Well, they peaked in December and they've had a 29% drawdown. So, a lot of pain in that area as well. And then similarly, this FFTY, we always show again just to give us that gauge of how's our style doing. Well, not well, but to be fair, nothing's doing well. And the whole point is to get out, to avoid this. But everything's out of style. Nothing's exactly working. It's a difficult market to trade in, that's for sure. So the FFTY down, the mutual fund index is down, and the the indexes are now officially in that bear market. I've been showing this, the 10-year treasury. Again, you've maybe seen this too out there. There's this narrative that Trump wants to tank the 10-year because our interest is so high and our interest cost is so high, and he wants to, lower the deficit. That's one big lever we have right now. It's this big lever to lower interest costs. I don't know what it is a year, but it's significant, right? And so if we can bring that down to 3% or whatever, 2% and refinance, great. That solves a big part of our deficit problem each year. I'm not sure if that's legitimate. I don't think it really is that he would want that. I do think he wants rates down, but I don't think you tank the economy on purpose necessarily to bring rates down, but you never know. This has been acting normal until the last 2 days, I'd say. I just wanted to flag, which I find very interesting. Rates are up substantially, in 2 days, and the market has not bounced back at all. So to me, the flight to safety is it now? Is it not the flight to safety now, or what has caused this massive snap back in rates when we've gotten no relief in the stock market? Because again, Roy and I were talking again, and we're just thinking, or what I've talked about how it's the Armageddon scenario where you've got stocks down, bonds down, dollar down. It's not exactly that's kind of the worst case scenario for everything, right? Is when all the three things are down. You get no offset. It looks like just a flight out of US dollars, perhaps, or it's a flight out of anything. You just can't, it's just you liquidate whatever you can, perhaps, right? So maybe there's a rebound in rates, and it's bear market action where it's all very unpredictable and volatile. Every asset becomes extremely volatile because people get blown up and then maybe they have to sell treasuries, maybe they have to sell gold tomorrow, maybe they have to sell all their Bitcoin, so it's all these kind of inexplainable moves that are happening across assets, or it's just so choppy where it's you never know. I put the CPI in here. I don't even know, Roy, do we have the CPI this week even?
I think the CPI is tomorrow, if I'm not mistaken.
Okay, it usually is.
PPI is
It's
next
usually like
day.
the day after our meeting. It's taken a back seat during all this, but here it is. It's fine. CPI on its way down. We're going to talk about deflation probably soon enough. If we're in a recession, obviously inflation doesn't matter. It's going to go well below 2%, most likely if the carnage does not stop. So nothing to see here for now, other than the expectation it might just go much lower um, than that 2% target soon. Here's the core CPI, same story, on its way down slowly but surely. It was going to be steadily to its 2% rate soon enough, but again, it's just going to be faster if the recession takes a deeper hold. But for now, I know we've shown this in the past. We were talking about this more in 2022 because it was more of a real time, gauge for inflation. Watching it track down towards the target. Now we're at new lows in inflation, and based on this gauge, it's like 1.75%. It's been a very good. It's a very cool tool, like Trueflation. You can check it out yourself on any day. Every day they're updating this with the next data point. And so that'll be interesting to see too, because over the next month, if it tracks lower and lower and lower, it's good to know um, before the CPI comes out. You don't want to get the data um, a month late. You want to get the data in real time, and this is a really good free resource for the most part. I know there's paid tiers, but check this out. Stay updated on this at their website. Okay, and then with all this chaos, of course, the shorter term treasury rates are trending down. That's basically pricing in Fed cuts. So, we've seen a drop in the 1 year and the 2 year. I think it's interesting too that they haven't undercut this low, despite, this was like the Bank of Japan or the yen carry trade unwind around that area, right? In August, where we had that steep decline in rates there too to kind of stop the bleeding there. That was part of an important um, change in rates during that other panic we had 7 months ago. During this panic, we have not had the necessarily the same move down in rates, which I find interesting. But here's the Fed funds path. This is this busy chart. The black is the expected Fed funds rate over the next 6 meetings. So now we're pricing in, 4 cuts by the end of the year about. The blue is 3 months ago. So what that was January 8th, right? Just at the start of the year, people were saying, inflation's sticky, the economy's booming, bam, bam, bam. We were not going to have any cuts hardly 3 months ago. And then you can see where we were a week ago and a month ago. So basically just since the tariff announcement, we've had this other further shift down to this black line for the Fed funds path. And, of course, this is up for major adjustments perhaps in the near future too. But that's just to give you a sense of what's being priced in now. And if you're in the boat of, the real economy is just getting started to get bad, that's going to come down quite a bit across the board. And so next, I'm going to talk about some of these things that we talked about last month too. This is the as far as sentiment, right? We're looking at sentiment indicators and breadth indicators and talking about if we're near washed out levels. The VIX, this is something we were looking at last month, and we were probably here about 27, 28, right? And we talked about how, okay, sentiment's bad. Yes, but is the VIX really elevated? Not really, right? At under 30, that was not a meaningful spike. We arguably got an extremely meaningful spike at 60, right? And that, that's very meaningful, 60. And then that compares to that August level where it actually hit 81 pre-market, but by the open it was only at like 67 on the VIX. Um, but this is one of those top five, top 10, whatever it is, readings on the VIX, and something important. It just can't be the only thing to trade off of. And if you were trading off of it, maybe you got a sort of a scalp trade. What was that, Monday? Just yesterday morning. Um, but but other than that, it's hard. Anyways, but the point is that is a very meaningful number. We are seeing very real fear now, um, since that last month ago. And then similarly, this is something we look at, that put call ratio. So the puts to calls, more puts means more fear, right? And so that 1.15 level is that green line. So that's the number we always reference for fear. And you can see where that lines up, these peaks or these spikes, and how that lines up compared to meaningful lows in the market. So in 2022, again, it's so difficult because you can get these spikes and you get these rebounds and these snapbacks, but the fact is when you're in a bear market, it's still extremely choppy, right? Like if you see 2022 where we spiked above this one, two, three, four times in 2022 before well, I guess the bull market, I guess, technically started in October, but um, that does help as far as if you're trying to trade these choppy environments, having the spike to a considerable level is a good sign for putting in a durable low, but we have not got there. This is a 5-day moving average on the put call ratio, and so we've had 3 days close to 1.2. And so that's going to drift up, obviously, if we consistently get that 1.2 reading, but it's not there yet because it's only been a few days of that elevated level. But yeah, so this is another indicator we're looking at. The VIX has spiked quite a bit. The put call is on its way. I'm pretty certain to spiking. This is the other sentiment indicator we look at, one of them, the National Association of Active Investment Managers. So down here, it tells you how long people are in the market. Now their active managers based on a survey are about 49% long. The 2022 low, that was like 15%, I guess, 18%. I can't remember exactly what it bottomed out at, but that coincided with a very, that was the low, this active manager survey. So we really like this one. It's also particularly good at tops, where if you're north of 100% on these readings, you can go back and see um, how good it timed market pullbacks as well. So we find this one very valuable when we're watching this sentiment indicator as well. That's got further to go. So in an ideal world, you're getting all of these things together, right? Um, and even then, it's just treacherous, but we don't have all of these things going together necessarily. So, um, and this is one other thing that we'll talk about I guess we'd say sentiment. This is that high yield spread. So, as the spreads are increasing, that's that credit risk that's increasing. Um, Back down here, I'm sure we talked about this in January and February. The high yield spread of this 2.75 was the lowest it's been since 2007, um, which was, pretty incredible, to see something that pricing that much perfection in a market, perhaps over 18 years. So that was, in retrospect, maybe more of a sign than we realized, how tight those credit spreads have gotten. Since then, they blew up. They're taking out that high from this is the November low back in 2023. So we'll see where these end up, but this is never this is never a good sign. The credits, the first stage of this bear market is, it's uncertainty, it's unwinding of maybe speculative things, unwinding of crowded trades, and getting rid of froth, and then credit things happen and dislocations happen and things like that. So that's the potential out there. Um, Something to keep in mind without staying bearish is being prepared to pivot bullish, especially on maybe Fed action, right? The Federal Reserve may take some significant action in the next 3 months. I don't know when. And when they do that, you're going to see these credit spreads collapse again. They could take out the bazooka and stop QT, cut rates, back bonds for who knows what. But yeah, this is the contagion kind of fear that you worry about whenever you see these things exploding to the upside. Um, but yeah, I mean, again, nothing to we're just monitoring it. We're pointing this out to you. It's not something we trade off of. It's not something you can trade off of, but just understanding in the macro picture that under the surface, don't forget there's this credit thing and the leverage in the economy is a lot of times what makes these things turn out worse than they otherwise would be. So we always keep an eye on this. Okay, and we'll talk about how oversold we are, and this, and it is encouraging when you put all these things together. It looks like, man, we're due for a bounce. Um, but everyone's been saying that for a month now, and you would have been hurt pretty bad if you'd been trying to guess the low for a month. But this is the stocks above their 20-day moving averages. This is the lowest we've seen it since the low of the 2022 bear market, and we don't have data further back, but that's that September October low for the S&P 500 was right there. But that's 9% of stocks above their 20-day. So yeah, short term, really oscillator at a very, very low level here. This is the stocks above their 50-day moving average, 8.5%, also coinciding with a very, very washed out level in 2022. I guess that was May when that occurred. And you can see it's just such an imperfect thing. In May, we hit that all-time low on the stocks above their 50, and you get that 1 week bounce, and then you hit a new low in the indexes, and then you rally again, you hit another new low. So it's by no means the all clear, but if you're so inclined, these are the things you look at to consider, for a bounce trade. And here's the stocks above their 200-day moving average. That's at 13%. Again, it coincides with very, very low levels that we saw in 2022. You don't get much lower than this in this indicator either. You can't, you only got 13% more to go. So yeah, so all these things, God, washed out, absolutely. Um, but here's our problem. Okay, we've been persistently oversold according to a lot of indicators and according to all, a lot of pundits out there on CNBC and everywhere. We've been oversold. Okay. We had a little relief, and then now here we are oversold again. This is not updated for today. I'm not sure where it ended up today, but maybe it might be a meaningful. I'm guessing it's lower than this August low once we get that data. But yeah, so all this does add up to, man, like this oversold bounce is due. If you've been paying attention to the market like every minute of every day, you may have seen that once we got the whiff of some trade relief, we rallied 5% in like 20 minutes. So that's clearly what the market needs, some kind of compromise, and that's what will fuel the snapback. But I don't necessarily, I have no desire to try trading headlines every 30 minutes either. But Um, we are oversold. We're extremely bearish on these sentiment indicators. All these things are certainly aligning, but it's just a matter of if you can actually effectively trade that regardless in the volatility that we're seeing. So here's that McClellan oscillator to give you a sense of how oversold and how often this might occur. Let's just say we're at like 75 um, after today's move in the Russell or what across the indexes. Maybe we're at 75. This happens a good amount of times. It's not uncommon. And then finally, if you want to see the nasty, nasty bear market in this data point, from the most, sharp, the real sharp bear market we had in 2020, that, there's your reference point, right? For how low it can go and just how persistently low it can be there too. That was there for several days, several weeks, where we were oversold below -80, right? So we were lower than where we currently are for several weeks in 2020. And who knows if the effects of this are worse than that or not. Okay, I'm going to show a few more charts, and then there's some interesting data points about why to stay optimistic too at the end, from a Twitter account that I follow, and probably some of you do, who I think has a lot of good data points and points out a lot of these um, interesting tidbits. But here's the Nasdaq and the MACD. We got this, buy signal in late March, mid to late March, and that kind of coincided. This is where we took a stab trying to play a bounce, right? Everyone was looking for a bounce, and we thought, okay, maybe we can rally to the 50-day, right, and get a whatever that is, 5% move in the indexes. We took a stab there, got stopped out, taken out the low very quickly the next day. And then since then, the MACD has rolled again and you got that sell signal a few days ago in the MACD. And then this is an important chart that we always look at. We talk about the 10-day and the green moving average being the 10-day and the pink being the 21-day. We talk about that as our sort of intermediate term trend and how the 10-day crossed below the 21-day right here. And the trend based on our definition was down in the intermediate term. I believe if I remember correctly, we were 25% long on this day. I don't remember what we started at. And then on this day, we sold the open and we're fully out, for clients, that is, and stuff. But that trend has kept you out, helped to keep you out, knowing to stay cautious based on that measure. You can also notice the 50-day, declining now, so, at the same time, right? So that, confirms that sort of longer term average is turning as well in those same few days. Now you've got this golden cross, great, the 50-day crossing below the 200-day. That's one of those iconic sort of technical analysis events that people talk about. The problem with it, of course, is it's really, really late. Okay, that doesn't help you, right? It didn't save you any money, but it just kind of gives you an idea of the measure of the magnitude of damage that was done. And one thing, I didn't include this chart in here, but Nvidia being the leader of the last bull market run, a lot of these things happened earlier than for that stock than the indexes. The 10-day had already crossed below the 21-day, before the indexes. The 50-day had been in a steep decline. It was living below the 50-day. And I think the cross of the 50-day below the 200-day, happened several weeks before the Nasdaq one, I believe. So that's something interesting. The leading stock, of course, changing character over the last several months, kind of hinted at a sick market. And then, okay, here's the last chart we're going to look at is just the Nasdaq weekly chart versus the 30-week moving average. We always consider this two consecutive weeks below the 30-week is a change in long-term trend. So we got that 1, 2, 3, 4 weeks ago is when that on that definition, that long-term trend changed. Um, if you're a long-term investor even, and you don't touch your account very often, that's one of those times to touch your account perhaps. But um, that's changed. And this a lot of times apparently I think Stan Weinstein, right? He's the one that coined this or that talked about this in the past. And he likes to use the 200 day nowadays. Same idea where we were below this 200 day on the same time frame anyways. So, anyways, that's our long-term trend outlook is how you can see that the index is now below their 30-week moving average for several weeks. Okay, and now lastly, I'm going to put out a few tables. There's a few tables here from this guy. Okay, Charlie Bilello, I guess is his name. But I follow him. I don't know if he tweets this much or if he's just been extremely active, like waiting for his time to shine. But he's got a lot of interesting tables and data points out there that I just thought I'd share with you guys. And they're, somewhat positive, right? Where it talks about, man, we've had these really, really bad declines and really, really high VIX spikes. But what happens later? Okay. Um, okay, so these are the biggest 3-day declines, and then what happens a year, 3 years, and 5 years down the road. Right, and to be fair, in general, we are higher a year later than we are from today, right? And 1 year from now, 3 years from now, 5 years from now. The long-term trend of stocks is up and to the right. So you would expect that. But, this is a 100% hit rate whenever you have these really nasty 3-day declines. The upside there is pretty significant for a lot of these. The problem, of course, is being early. That's always the problem. But this generally paints a decent picture, right? But I guess the thing you have to risk is, okay, am I buying on the 19th, the 20th? Am I buying on October the 16th, right? Or of 1987? Or am I buying in October of 2008 or November of 2008? Or where that's a month of pain you had to endure by being early, perhaps. So that's the tricky part. But the point is, and even if you didn't worry about that, you still may endure. You may endure like a 20% drawdown. But the fact is, you did rebound following these nasty declines. So that's the whole point of staying engaged. I mean, these bear markets are moving fast, right? They move fast. We know 2020 was fast. 2022 was a brutal one. In 2025, it's yet to be seen, if it's going to be this long drawn out one. And it might, right? It's just what's crazy is how it can end with a tweet. It feels like, right? That's what everyone thinks. It can end with a tweet where he says, we made a deal with China, everything's gone, or, we're going back to the way it was, or I don't know, but who knows? I don't know if he's going to do that. He has not blinked yet. So, we'll see if if it becomes a big drawn out one or if it's a quick one. This is the S&P. Oh, this is kind of a mixed bag. Okay, this is a mixed table I wanted to share from this guy. The worst performance through the first 64 days of trading. 64 days. So I can't remember exactly. Oh, this was 4/4. So that was Friday, right? It's the fifth worst. Okay, not bad. No, fifth worst. And then here's what happens at the end or the rest of that year. Um, you've got a couple of look. Okay, this what stands out? This one stands out as extremely negative. A couple stand out as extremely positive, and then all around the place, right? All over the place. Um, but you're 50/50, it looks like, for a positive or negative year following these. So that's certainly not painting a rosy picture, right? For the rest of the year, it's really a coin flip, and no one has any idea what's going to happen because there's a lot of things that are in flux. But again, check out his Twitter thread after this too, and see if you can find anything. Give him a follow. And then this is another table just about VIX spikes too, and talking about the forward returns. Okay, and this is a lot of green, so this is the most positive one. We just had that really, really high VIX spike, right? It hit 60 something um, a day yesterday.
Hey, Wes, by the
Um,
way, overnight,
yep,
the market's down considerably. Nasdaq's down 350, and the VIX is spiking up to 90 from that 91.02 area that we saw last
90,
August.
90.
Yeah.
Nice. All right, yeah. So that's the whole point. You don't want to be early. So yeah, this is looking at these the VIX spikes above 45, the weekly closes for VIX. These it's somewhat interesting, but they cluster during these bear markets, right? So you were above 45 um for a lot of these bear markets, and that's I guess that's why we're cautioning now to not do a whole lot, anyways, because you could be buying the VIX at 79 or 70 on October 10th of 2008, or buying the VIX at 49 5 months later, right? And so during that time period, you probably had a 50% drawdown or 40% drawdown. Um, but I guess what's interesting, even despite that, right? Even if I bought the very first VIX spike of that 2008 crash, which looks like it was 1010, right? You bought the first spike at 70, you were still up 22% a year later, which is pretty impressive considering, you did have a pretty massive decline from October 10th to March 6th of 2009. So, anyways, yeah, when these I guess basically what it says is, hey, out of a bear market, you're going to get a bull market. Um, and this is a key thing that happens. This is a key characteristic of really nasty bear markets is this elevated VIX, and we're getting it. We are getting it quite a bit. So, and also, by the way, look at these. You can see the comparison in returns over these 1, 2, 3, 4, 5 year periods. So here's what it's looking at with these 21 spikes in the VIX. Your odds are better for better returns after a panic, naturally. And then here's the kind of standard returns over these time periods. So yeah, I think it's interesting and something to, stay engaged, obviously, because when we're out of this, just like in, the what felt like a very brief bull market, there's a lot of opportunity to move the needle, um, move the needle, but hopefully everyone here has taken some defensive measures and all that, while we sort of wait and watch, um, from here. That's it. That's all I have. That is it. I will stop sharing. I can turn it over to Roy. Um,
Okay. Thank you, Wes.
thank you. Thank you for listening.
Let me share my screen.
Uh-huh.
Okay. Do you guys see the FinViz table on your computer screen right now?
Yeah.
Okay, good. Okay, so I just mentioned the VIX. Now, depending on how it's calculated, it can be these derivative products that measure the VIX. They have different time horizons.
Hmm.
Like the VIX right here on FinViz, it's 40.80, but you can see sort of the trend with what's going on here. Another common way to trade it without actually buying or selling the futures, it's through the VXX. And this is what I'm pointing out right here. This is showing 89 right now. So it's rivaling the big sell-off and the spike that we had. And again, this was one of the top 3 or 4 spikes going back over the last 10 years or so. So we are getting serious elevated fear right now. So, just keep that in mind. I wanted to point out as well, we did a series with Traderline on navigating and how do you pick the market bottom, and also how do you pick the market tops. And we went over a series of these, so we would recommend you listen to those videos. They're quite instructional, and it brings you like right up to speed, sort of with what's going on right now. We did a series on selling stocks about a month ago, and that was very prescient as well because we were getting kicked out and moving to cash, 6 weeks ago. Not exactly at the top, but within 7 days of the top. The problem is, when you're trying to manage risk in your investment portfolio, you don't know that the top is in until after the fact. But there are signals that you need to be aware of that you should consider always. And one of those is the leading stocks peak first, then the technicals turn over like the MACD and the stochastics and some of these other technical indicators, SKSD indicator. And some of these, they give you clear momentum divergences where they show you that momentum is it's declining. And so when you take the leading stocks, plus you take a look at the technical indicators, and then finally you take a look at the trend, those are the three steps that we employ in terms of reducing exposure in the market. When the leading stocks peak, and again, most of the leading stocks peaked when China's DeepSeek AI model came out. And, we got caught in that as well. And a lot of the power companies, the data center companies, and a lot of the enterprise software companies that specialize in AI. And that was really a shot across the bow, and right there about 6 weeks ago. And then again, the leading stocks peak, the technicals peak, and then the trend peak. Now, it's when you look at the trend, it's quite ominous. So, with the market in a very oversold position here, we have no idea where the market will finally bottom. We're trend following. So when the market finally capitulates and then it turns off the bottom and provides a follow through day, that's the time where you can dip your toe in and try to achieve some traction. The problem is, from where the market is currently situated, that there's no leading stocks. We're not really going to go over any stocks. We have 0 stocks on our buy list. All the stocks that were previously on our buy list, they're all broken, and growth is under tremendous pressure here. So if you've done a good job in terms of raising cash and not sticking with the buy and hold mentality, and watching the signals that IBD eloquently presents, you would have not necessarily had 0 drawdown, but your drawdown should be minimal based on the 3 factors that I just told you before. From a long-term perspective, until the market trades back over the 30-week, it is quite plausible that you should just basically sit out of the market. One of the problems following really, really good years, and as you guys know, we had terrific years last year, it's giving it all back in the bear market. And, the reason that we reduced exposure there at the top based on the indicators that we were looking at is because all bear markets start off with like a 5% correction, then a 10% correction, then 15. Now we're way over 20 now, and we'll probably be close to 30 maybe tomorrow before the damage is over, unless the administration does something or the Fed does something to stop the imbalances on the sell side. The problem is is that we've only been going down for just a couple of months. And when you take a look at the long-term charts, let's take a look at the Nasdaq, for example. We had this climactic low yesterday, and followed by a big gap up. The market was up about 600 Nasdaq points on the open, and we closed down, I think, 350, and we're showing that we're going to open tomorrow down another 350. So we might take out yesterday's low on the open. And so that's going to really, really generate a lot of fear, because we had this potential key reversal day yesterday that's being thwarted today and tomorrow. So from a follow-through day standpoint, from a swing trading perspective, yesterday was the first day of an attempted rally, because we've been in a correction. It was a positive day, closed up 54% off the low. And so that was day one of the potential attempted rally. Today, we still have a potential rally. And if we don't take out yesterday's low, tomorrow will be day three, which opens the door again for another potential follow-through day. When you look at follow-through days, you've got to be careful, because follow-through days, they work about half the time, but no new market uptrend has ever been established without having a follow-through day. But the problem is a number of these follow-through days don't work. Like this was a follow-through day right there. And so Wes and I believe, we think, and we'll see how we play it, but we think that if we have another follow-through day with all the overhead resistance and all the uncertainty regarding earnings, and how tariffs will affect really the world economy, that we just don't think it's been a long enough or necessarily a large enough decline. So it can get real dicey here. So you've got to be very, very careful. But if you've got to make sure that you can sleep at night. But this is definitely based on the indicators that Wesley went over earlier. This is definitely one of the most lethal, violent bear markets that rivals the 2020 bear market that occurred over the course of, say, 30 days. But I think this was about the fifth largest drop of 10%, in the fifth quickest drop of 10% in market history. So it just happens very, very quickly. So, it's important to be aware of, these metrics so that you can dodge them and initiate some defensive action the next time that it presents itself. So let's take a look at.
Dad, can I just ask one
go ahead.
question? It's an unfair question and an impossible question, but someone asked it, and just in case, and I don't have a great answer. Someone happened to ask, a Zoom user, I'm not sure who it is it too late to go to cash?
Boy, I can't. I couldn't begin to answer that.
I know. Yeah, it's a very, very tough. I don't know. Yeah.
But let me show you like what you might expect. Okay, from a short-term perspective, let me show you what you might expect from a technical perspective. So let's take a look at the 200-week moving average. Let's go to and this is sort of where you would expect the market to hold. So this 200-week, and this is the Nasdaq. So the 200-week on the Nasdaq, it's 14,608, and we closed at 15,000. Looks like 15,267. So it looks like we have another about a 500-point drop to get to that 200-week. Let me show you what it looks like again on the Qs too. So because most of you are trading the Qs, and I also ran some Fibonacci retracements to give you an idea as well. But the 200-week right here, and this is what Wes and I were looking at. we're in this nice uptrend in that bull market from 23, 24. But notice how we came up and created this double top on the chart, and this double top on the chart is consistent with the stage 3 sort of topping process. We're fully in stage 4 now, below the 30-week moving average, but the 200-week moving average, there's your downside. So the downside, the first downside that we see, it's about 383 on the Qs. So I think this is going to be a magnet. And that's why we didn't try on that reversal. Remember, the market was down 1,700 points yesterday on the open, and it actually closed, much higher on the day and giving it all back today. But, as you study these bear market sell-offs, you get such violent 1 and 2 day moves until the trend changes. So you can see here on the weekly, this is the first time that the 10-week, the green line has crossed the magenta line, the first time in 2 years. And we've broken this channel, this long-term channel, if you draw a trend line, and we've broken that significantly. So to us, this has only been a 2-month bear market. Notice in the 2022 bear market, it lasted, almost a year. So it can get very, very tricky. And what can happen if you're on the wrong side of the market and you're down, and you try to make it up too quickly, you'll chop yourself up. So the reason we're not going to talk about, many stocks is because the market conditions are so unfavorable right now. And there aren't any stocks that are in a viable position that we're aware of. And we think that anything that's held up, it's subject to come under distribution because they get everything. They get everything the market participants do before the bear market's over. So this is what we're worried about, a longer term bear market. And, this has been quite a dramatic drop, but it's going to take time. Notice the MACD where it bottomed before. So we have some more downside, the downside potential that we're certainly may experience, even tomorrow and even to the rest of the week, until we get some type of clarity, like like December 24th, 2018. I'll show you that bottom in a second. But this is a Fibonacci retracement running from this low where we believe the last bull market really began in November of 2022. And so we ran this Fibonacci retracement. You can see we're right at the 50% level, which signifies this breakout, this high from the 2022 top. It also shows the next level of support, which is the 61.8% level, which is below the 200 week. So it's quite common to go through some of these significant levels. And you can see down here, you actually went through the 200 week, and it took a number of months, 5 or 6 months before the market regained its footing. So we would not expect a V recovery here. We would expect a grinding consolidation, sideways action, and new leadership to emerge that have great earnings prospects, that beat and raise their guidance. And we don't have earnings start this week, the end of the week with the bank stocks, and we think they're going to be the first ones to give very, very cautious guidance. We just don't see how Google and Amazon and Netflix and Apple, we just don't see how they're going to come, get out of here unscathed. So you got to be very, very careful and, understand that, if you understand that we don't know if the markets can go down 30%, 40%, 50%. No one knows. And it just depends on how bad it gets in the economy. But you can see Wall Street lowering all their targets on the S&P. They're lowering all their earnings estimates, and that doesn't bode well for the short term anyway. It's going, there's a lot of turbulence and a lot of churning, a lot of chopping, just an extremely large amount of volatility here. So this is where you might look. So you don't have that much downside. It was about 10% more downside to this 200-week, but that's the cues. And if you take a look at the spider, what might be a reasonable objective on the spider and the S&P? Let me see if I've got it under the SPX. Yeah, here's the S&P. So same kind of scenario. You can see you're in this nice uptrend. There's a Fibonacci retracement. So these levels, sometimes it's uncanny where the market finds support. And so you can they're just conditions. You just check each of these levels off. And it's really, an art in terms of putting everything together to make a coherent, investment strategy. But the most important part of your investment strategy, of course, is risk control. It's risk control and position management. So what we're going to do when we move off the sideline is our position sizes. In our swing trading strategy, our position maximum size is 15%. But we're going to start with 2.5% positions. And just 2.5%, and we might have 10%, in the market to try when we have a follow-through day, or if we have some type of major key reversal day that's potentially signifies a potential bottom. But you don't want to put 50 or 100% of your capital if you're sitting on the sideline and be on margin at the first attempt of a turn. We had the first attempt of the turn yesterday, and if you would have tried it on that first attempt yesterday, you're down 5 or 10% right now. So you have to understand where we are in the market cycle and avoid at all costs just damaging your portfolio more than it has been so far. So notice here, see the 200-week, that was support. Going back to the 2020, you actually went through it. You went through that 200-week, and see, we don't know if it's going to get so bad that this happens right there. And that's, we're not even at the 200-week, and this is another 12% below the 200-week. And if we would get a move like that, that's going to put you down. That's going to put you down close to 35 to 40% on the Nasdaq. If we get this type of pain, this type of liquidation. But notice, see this 200-week. It's for years it's held at this 200-week. The market's held at this 200-week. The red line came right to it in 2016, right to it in the 2018 low. Blew through it in 2020, and now you see where we are today on 2025. So let me show you just a couple of things, and I guess I'll use the cues for this example, and let me just change the date, and just sort of like just to give you an idea, let me change this to 2023 on the date so you can see this 03/04/23. Okay, so this is how these bottoms take place, and this you can see this is I'm looking at the weekly chart here and see where this 10-week is below this 21-week. Look how long, and this is really what we're looking at. And see whether that's 10-week is below the 21-week, and the 21-week is below the 50-week. That's when you just have to wait, bide your time, and wait till it finally turns. You can see it finally turned here a year later, a year after the market top. So we're really paying attention to these long-term trends, particularly when you see what the market looks like, on the monthly charts. And when you finally, this is looking at it on the monthly, and notice this is the 2022 bear market where you had these brutal downturns. You had these brief 5 to 10 day moves up and then a resumption of the downtrend. So, there are going to be periods where you can get these, a snapback rally, and it's going to roll over if the market and the economy and if it gets worse and we go into a recession. So, notice you're not out of the woods until you're finally back over the 200-day. The 200 days finally flattening, and all the damage has been done. And you had a follow-through day right here off the low, right here off the bottom, to signify that potentially the trend, is changing. So it's going to take, it's going to take a tremendous amount of patience and discipline to just manage the risk on your portfolio. So this is an extremely crucial time. And remember, it's the last few days of the move down that if you're on margin, that you can really you can blow your account up. You can really damage your account significantly. So don't do that. Just do not do that. Don't try to make it back in a couple of days. Don't self-sabotage yourself. Just adhere to your rules, which are position sizing and stop losses. If you decide to trade anything. So let me take a look here, so you can, just to give you another idea, just so you can see this. Let me go back here to today. Oh, let's take a look how this looked, by the way, on the monthly. Okay, see, here's the monthly. There's the top, and this is the 2022 top. Nice uptrend after you had this great move from COVID, this nice bull market, this horrible bear market, and look at, and we're looking at on the monthly chart, so you can see what this looks like. Now, what does it look like today on the monthly chart? Let's just take a look at that, just to give you an idea. And, we're just looking and trying to find precedents of what this market looks like today compared to other times in the past, to just give you some semblance of, how you might handle it, technically. And there's your monthly. So this monthly, you've rolled over, big monthly move. It certainly looks, like we're going to come back into this area here, but you just don't know if we're going to stop here, or if the recession gets so bad that you come all the way back to the 2022 and give all these profits up. You have given up all the profits from here, in the last couple of years on the S&P, in this, in the major drawdown that we've had. So notice here where the MACD, see on the monthly, see where it's just, you're just getting a sell signal. And that's why it's very concerning to us that, and this is just a momentum indicator, but you can clearly see that it takes time to finally bottom out on these indicators. And this certainly doesn't look like a bottom, does it? Okay, let's take a look at 2020, just 2020 and 2018, and then we'll open it up. 2020, let's go to April 20 of 2020, and there's your bear market. Notice where the bear market, see, there's your 200-day, and you went You went significantly through the 200-day. And then what happened here is Powell pivoted like right off the bottom, where that's where he guaranteed. We had all the banking crisis, the bond crisis, credit crisis, and they guaranteed all bond holders. The government was going to back all corporate and treasury bonds, and that supported the market, right there. But there's your climactic move, and right down here, see at the bottom, it just gets real messy. And your follow through day was right there to tell you that it's okay to start to dip your toe in. And here you could guess what's the beauty in the follow through day that O'Neill established was you're going to get in close to the bottom. And if you execute flawlessly, see, here's the top in 2020. So you had a significant move down here, and no one can really call exactly the top. It's just there's impossible to do that, but you can somewhat get in off or get out near the top when when the indicators roll over. And if you can miss 80% of the bear market and participate in 80% of the bull market consistently over a full market cycle, you'll make more money than you know what to do with. So that's the key. That's the beauty.
Sounds like Trump.
That's the beauty of trend following. Did we have a question? Okay, let's take a look at the last example, and just to show you what it, again, what it looks like. And by the way, see if you go out here and change the date here, what happened after that? That's when we had the bottom. See, there's the bottom way down here. Here's your follow through day right in here. And that led to this incredible money making, one of the best years that we've ever had in 2020 and 2021, just because you were so oversold and so washed out. And all those indicators that Wes showed you, we're approaching these levels, guys. So, with the open right now and the open in the morning and the overnight pressure on the market, that's going to, there's going to be a tremendous amount of volatility, tomorrow. So, there's going to be a lot of people that, that panic sell if they haven't sold. And that may be the ultimate low, or, we prefer to wait until you get, this trend change. Notice, see, from that, when you're looking at the trend change, notice this 10-day crossing the 21-day, the 10 days, the green line, crossing the blue line. That's telling you the coast is clear. And right there, when you get into these power trends like that, that's where you make all your money. So we're waiting for this, not necessarily to get in exactly at the low, but you're waiting for the trend to change and then enjoy these moves. This move from 5 months, normal pullback, up, down, then this other move, right? Consistent move, another 4 to 5 months. So that's the posture and position that we're all looking for. So, just certainly keep that in mind. And the last example is I remember this clearly. It was December 14th, 2018. I can go back to 1990, 1987, 1991. Just, it's all there. The playbook is the same. It just repeats itself. So this is the, that's 20, this is the 20, what bottom is this? Oh, that's the 2020. I want to change this to 19. 1 second, date. And here's the bottom right here, and it closed at the bottom. And I remember this because we put out a piece here saying that we came out and said we had a tradable bottom. And so this is like we happen to get it on we got this on the day of the low. But look at this volatility coming out of this bear market, and see how when this trend changed and turned back right here. There's the trend telling you to get in, but it was so oversold on that day right there that we thought that the market was actually putting in a bottom. And that's the kind of panic, and that's the kind of panic that the market looks like. It's being challenged with today. And so this was a 4-month bear market. Most bear markets last on average about 9 months. And again, we've only been in a 2-month bear market. So we're in a bear market by every measure. And we don't know how long it will last or how devastating it will be before it's over. And but we do know that.
Sounds like you're growing a baby.
What's that? Yeah, we do know that it's all about risk management, and that you must stay in the game. So stay in the game for the good moves. But we're on maximum alert for preservation of capital mode right now. That's all that I had in terms of the market. I will pull up just a couple of these stocks so you can take a look at what they look like. 040825. See, this is just horrible. And so this is Google. Do not think that just because it's a big company that it's a good investment. You can clearly see the trend has been straight down, and from the fake breakout, and then right there was that was the China's DeepSeek that impacted the markets, in the technology sector. And so there's just, where's this trend going? Where is it going to end? There's no way of knowing, particularly if we go, if the market goes into a recession. But they all look this way, and these aren't going to be the leaders, guys. Amazon is not going to be a leader coming out of this. It's going to be names that probably we don't know about. There'll be some type of thematic play, but this is definitely not going to be a leader. Wes and I, we were talking about Apple, and there's Apple, and Apple does. I think they do about 20% of their business in China in terms of production. I think, or maybe that's 20% in India, and maybe even more in China. And I did read an analyst report today where they thought that the impact from the tariffs were going to impact them by $2 in earnings right off before it even gets worse. So, you look at a stock like Apple and, see it's going through the 200-week. Where is it going to bottom? When the fundamentals are clearly deteriorating, and the technicals are showing you that as well. So they just look, like they need time. And see, really back here in 2022, see, look at Apple. It went sideways. It finally bottomed and went sideways. You did have that bounce right there, but you had months where it went sideways. So that is really what we are expecting. But you got to keep your mind open to a change, a major change in economic policy that reverses these downtrends, because that's what happened in 2020. That's what happened in 2018 or December 24th, 2018, when Powell pivoted. So that can be the recipe for coming out of this thing. It's some type of conciliatory remarks by Trump that get people to pile back in the market. But right now, it's just danger ahead right now.
Hey, Roy, you know how William O'Neill said that only 1 out of 7 leaders of a past bull market will be a leader of the next bull market?
Yeah.
When I look at 2018, December, you just mentioned it, March 2020, and end of 2022, all these big caps, they went down, I think NVIDIA went down 70% in 2022, and they all came back. So William O'Neill's statistics of 1 out of 7 only come back. Well, this statistic doesn't quite apply to the last 3 bear markets we have had. What's your take on that?
Well, my take is, look at this was Tesla. Okay, this is Tesla, where it was the big leader in, in 2019. And, this is a huge winner. You can see stock tripled from 20 to over 60, and then COVID hit. And, this is really before they really launched their production, in their vehicles, 5 years ago. And, so it went up, stock went up on, we call it a romance phase, got hammered. Look at this, this thing dropped 70%. But look what happened. It came all the way back. It was the quintessential winner of the next bull market. And there it is. So you can look at it here, look at this. It got down 70%, and then it proceeded to go up 5-fold. So there might be, something like a Palantir that we think is early in its cycle, that has, terrific management, that reported, really great earnings last quarter. It could be something like that, but something like that could come all the way back. But with that overhead, it normally takes time. So our job is to find, the next Tesla or the next Shopify. And Shopify had this same type of movement as well. But what these companies they had expanding margins, expanding sales, expanding revenues, and we don't see many stocks on our screens that screen well. So you can see this is Shopify coming off the 2020 bottom, and this you got a double there, and from the 2020 bottom, 40 went up 4-fold, and in the next year. So there are going to be a few of these companies that show up. We just don't know who they are. It could be some biotech company that has a new miracle drug that has great revenues and great earnings that the market embraces. But there aren't a lot of quality stocks that we can screen for. And everybody's looking at the same stocks. Everyone's looking at TGTX, Spotify, Netflix, just the leading stocks of the day, and and people they're very resistant to abandoning, like the Mag 7, and the Mag 7 are clearly in stage 4 declines, and that's, again, if you're waiting to buy Google because it's getting cheaper, it's getting lower and lower. That's the quickest way of, in our view, of having disastrous results. So you got to be very, very careful. It's better to wait for a consolidation and then have like your first up week, your first up month. It begins with having your first up day. So, in this environment that we're in, our attitude is you don't want to be a day early. A day early, it can be devastating to your investment portfolio. But if you're following the trend, you're not going to miss these moves. We always get these. We find them, and we'll deliver these to you on our Twitter account, on our Twitter feed, as well as in these meetings, as we have always, over the last 7 years, right here. But there's just nothing to buy. Nothing looks good. It's going to take time. It's going to take time for us to discover and find the next winners. But there's going to have to be a catalyst, and the catalyst typically it's an earnings report. So earnings start to come in, in the tech sector, like in the next couple of weeks. So it's really, it's even if we would have a climactic move lower, tomorrow, and then a key reversal, we wouldn't feel comfortable holding any of these tech stocks, like Nvidia, coming into the quarter. Let me change the date here on Nvidia. And yeah, Nvidia, of course, was one of those winners as well. So you did, Nvidia has been the biggest winner, I think, in the last 5 years, in the market from that 2020 low. And so from that 2020 low, you had that big sell-off, but look what happened with Nvidia. You had a 10 bagger, on Nvidia. And, again, this is, you can see where it peaked going into the bear market of 2022. There you had the 65 or 70% drop, and then it resumed leadership again. So it's rare that you have something like this, that a prior leader that comes back. But keep your eyes on something like a Palantir, maybe a Robinhood, and something that's that's relatively new, from an IPO standpoint, that has reported very, very strong earnings. Oh, I wanted to show you the top right now on Nvidia. See, we're in a stage 4 decline, and after being in this stage 2 uptrend for the last 3 years, you can see this topping pattern. This is what a top looks like. And where's it going? Is this thing going to the 200 week? And the 200 week on Nvidia is 55. I thought I thought it'd come into to the 70 area. But the real support, it's down here at 55. But you do see where the momentum is so weak that you could finally, you could finally try to put it in the bottom, here. But just the hint of a slowdown, in the semiconductor space, because it's, they've been expanding their capacity so much, and there's so much competition. I'm very skeptical. It makes me very suspect of something that's been the leader for the last 3 or 4 years. That's clearly in a stage 2 downtrend now. Comments, guys? That's sort of our take and our view, on things, right here. Let me see where futures are trading right now. FinViz. Yeah, see the Nasdaq 100. These are the Qs. It's down 2% after market. And let's take a look at that at the 5 minute. And there's the opening they sold the open, you gapped up 600 points. They sold right into it. And, that's where we are right now. So we're significantly under, I think yesterday's low was right back here. We're close to yesterday's low anyway. But this can trigger some selling if we just take it out even momentarily. So, again, we're not providing, advice, in these calls, but if, the first thing that you might want to consider when we get a follow through day, or if we have that climactic, reversal, it might just be the indexes. I think that's how we probably are going to participate, either in the QQQs and the SPY. That's and non-leveraged. That's how we're going to initiate our exposure incrementally, just very small. See if there's plenty of time to make money when you have a definite trend and the market is trading back over the 21-day, and and it's turning the corner. So short term, if you're looking at the momentum, look at the momentum indicators on the stuff that we mentioned to you before, like the MACDs and things like that. In more of an intermittent move would be, wait for a follow through day, and then wait till you get back above the 21-day, wait for additional follow through days. Then you start checking the boxes. You got to get over the 50-day, you got to get over the 200-day. And so, it's going to take some time, probably. Guys, that's all that we had tonight. Normally we go through 50 or 100 stocks. There's just nothing to look at, and we're sort of in this a spiral, this downtrend that we don't know where it's going to end. But the technicals are going to tell you when the lows end.
Hey, Roy, I have a question for you.
Sure, go ahead.
Based on everything you said and nibbling on both the SPY and the Qs, I have two questions. Number one, why wouldn't you use the leverage product, the SPXL or the TQQQ? And number two is, if we know we haven't hit a bottom and there's going to be some more potential dumping tomorrow, people panic selling, why not play the SQQQ?
It's too late. It's so fast. We had a 1700 reversal move in like 10 minutes. And it happened in 10 minutes yesterday. And if you would have gone long, you were stopped out and then lost a lot of money. And then then it reversed. We had tremendous volatility. When you take a look at that, and I'm just sharing with you. Certainly you can make more money on the TQQQ and the SPXU, which are the leveraged versions of both of those. But it's just you got to be so right, and you have a little bit more flexibility than just again buying the leverage stuff. When Wes and I took a shot. When we had that follow-through day, or we had that turn, that where we initiated exposure. We limited our loss. And think about this. This is a good thing to do, regardless of what you buy or what you do. Limit your loss to 1%, and that's what we did. We took like a 20% position. And limited our loss to 1% of our capital. So do that, and you can do that and be wrong a few times. Wrong a number of times. As this market has its ups and downs, and as it goes through this manic phase right here. But we actually use the leverage on that with like 2.5% positions on the TQQ and the FNGA.
And it kept
When we
us,
tried it,
it made us keep it tighter, remember too,
yeah,
right? Like, we took like 3% on that or something, like 3% loss on the
yeah,
TQQQ.
yeah,
Man, I can't imagine. First, and someone asked me what I'm doing in the market, like a friend, and I was like, it's too late to short, too early to buy, I think,
yeah.
and so gosh, shorting obviously it's late and it's very hard. And then, we just had a 5% intraday swing on the market today and the last 2 days. So of course you're stopped out on that stuff if you're trying. I mean, yeah, it's really, really hard to imagine buying the TQQQ for more than a day or SQQQ with that kind of move.
But
Um,
that is, I mean, that's the best way to establish a toehold. In one of the, again, it could be the SSO 2 times the S&P. So, just, everyone's got a unique risk profile. So, that's up to you. Just limit whatever you do. Don't plunge, and limit your loss, and take your losses, quickly here, because it's the cascading phase that,
and take
again,
your gains
that kills you.
quickly too,
Yeah.
you know. If you're short, don't expect to, short and have it go straight down for 5 straight days. You just take it in a day or two, whatever it is, any direction.
But this is, this NVIDIA chart is quite disturbing. The trends, you're in a stage 4 decline. Where is it going, is it going to bottom like right here at 90? There's no way of knowing, but it's in a downtrend, and it's still, all the technicals are skewing lower. Everything, all the momentum, lower, lower, lower. Even while the price gets cheaper and cheaper, the momentum gets weaker and weaker.
Yeah, now all of a sudden it makes perfect sense why Warren Buffett was dumping everything and selling all his Apple
Yeah.
4 or 5 months ago. You got to wonder if he knew something maybe we didn't know.
Well, he does have that. I think, is it called the CAPE ratio? The percent, the
It's
market
something like
value,
that.
market cap versus, our GDP.
GDP, yeah.
Yeah. So that was at the highest level, I think, since the 2000 top. But at the 2000 top, we had all these companies that didn't have earnings, where we do have, these are legitimate companies. They were just overpriced, like Apple and so forth. But, Apple is so big that, where, you just can't move the needle, with it. But, institutions can't move the needle. They don't have the earnings power. And it's been a place to hide out because of, quote, their balance sheet and cash flow. But, when, in a market meltdown, they get everything. Even the top companies, the ones that are most vulnerable, are the ones that have been the leaders before, that are losing their proportionate earnings power.
I think as for Buffett, he has other reasons. He's a value investor, long-term investor. I don't know. On hindsight, people like to say, "Oh, look, he went into big time cash and all that." If we
Yeah.
hadn't had this issue with the tariffs, nobody would talk about Buffett. He's been offloading for
Yeah.
years, and I mean, he has accumulated 300 billion of cash. He doesn't do that overnight in 2 months. I
Yeah.
mean,
Yeah.
Right.
Warren Buffett argument. I used to be a value investor, by the way. It is not a valid one for me.
Yeah.
Mm-hmm.
Roy, I have a question.
Yes.
So you're mentioning about the 200-week moving average, right, as
Yes.
that acting as support. I
Yes.
just looked at a couple of stocks, right, like Apple and Tesla,
Yeah.
right? Both have gone below the 200-week, right? And I see that from the 23 low that we had in at the end of 2022, right? They are below the 61.8 Fibonacci extension.
Yeah.
So does that mean that it is likely that they would give up the entire gains of the move? Is that the?
I don't know if I wouldn't say that it's likely. I would say it's quite possible.
Okay.
And it's again, we're in no man's land where if I had an answer, I'd give you. I just don't. I don't have an answer. I don't know where it goes, but I do know it's in a downtrend, and I do know how to identify when it's time to buy it again. But I just think it's with the earnings deterioration. I think it's dead money. I think it's dead money for it could. I mean, this could. When Cisco topped, in 2000, it took 20 years to get even. And Cisco again was the most powerful company for 10 years, for a decade in the market. But when Cisco peaked, and see if I show it here. When Cisco peaked right there, maybe I'll show this in Market Smith. You can see it a little better. CSCO, and go to the monthly. Look, Cisco, and this was the biggest stock. This is like NVIDIA and Tesla combined. There's the top. What if this is Apple and this is the monthly? What if this is Apple right there? After this big move, the leading stock in the market, and then you had made money in 20 years. So that's what you have to be careful of, is that any of these stocks, NVIDIA, Google, all these stocks, they go through these periods where, this is really an example that O'Neill was talking about, where big winners, big leaders of the market for a number of years. Look at this for, 5 or 6 years. Then when they finally peak, and the earnings, drop, margins, sales decline, they get overtaken by competition, and no advance for 20 years. So none of us, I think, despite what our age is, none of us, would endeavor to do such a thing by holding something that doesn't make money, in 20 years, and just holding on as it just crumbles. And this Cisco dropped 90%, and again, this was a huge winner for me, in this period of time right there, and gave it when it peaked, it was all she wrote. In this server era, the SMCI had this big move, and there's a good chance, that it's going to be interesting. So there's a good chance, based on the slowdown that's probably coming in capital expenditures in the data centers, that I don't think you'll see this high anytime soon. AppLovin, one of the big winners, and I wouldn't be surprised to see AppLovin come all the way back to right here on the breakout. So, and so that's getting cut into from here, from, right here, from the close today. And so that's sort of where we are, guys. We're in downtrends, and you just need, again, when you're in this downtrend, you need to have like a first week, a first month. You need to see a turn, see where you finally had the turn. You had the first green, blue turn, and from a long-term perspective, that's really what you need to, pay attention to. While it dropped from right here, 40, going through this support, 40 to 10, and, down 75% from right there before it finally turns. See, this Palantir's, look how this is really, this stock is really holding up. But you had this key reversal move up here at the top. But this is what a transition to, and a correction to like a potential new move up can happen if they come in with great numbers. This is by no means is this broken, but it certainly looks like it comes. If this market gets torched, it comes down here to the 10-month, which is 27% to right there. So that's why this is so dangerous. It's the last move down that can wreck you. It looks so close, visually, but that's down 27% right there. And that could happen, just like we saw in 2020, in 2018, in 10 days. When the market becomes under liquidation and there's no bid, and no bid whatsoever. But we're definitely watching this one. But you don't have a lot of stocks that look, like this. And again, its next measured move is going to be predicated based on earnings, and earnings are in 34 days. But it's got to get back above the 50-day, and there's your pivot right there at 98.18. So it's something like if this market would turn and this stock trades over 98, shoot, that's $20 too. Look at that. But that's why it takes time for these bases to form. And remember, bases, double bottom bases, cup and handle bases, flat bases. They all, you need 5 to 7 weeks, and of them forming. And we don't have enough time yet for the formations to establish themselves.
Could you please take a look at MicroStrategy when you
Yeah.
get it? Thank you.
Yep. So MSTR, and I don't know if you saw this, but there was an article in Forbes, and this is from a reporter, so I can't verify it in terms of its authenticity. But Saylor said he might have to start selling some of his Bitcoin for his covenants or something like that, bank covenants. So that would, and his cost, Wes, what is his cost? Wes, is it? I think he's signed up.
Yeah, I am here. No, it's 67 something.
67. So it's below, you're below the 200-day, it's below the 50. It's in a downtrend. The premium is over 100%. So the premium is trading 100% higher than the amount of Bitcoin they hold. So that is concerning. Before they did all these secondaries and bond offerings and things like that. That's why, and we got a double out of this twice last year. But that's why, you had this short squeeze, and it went much higher than the value of Bitcoin, than the move in Bitcoin. But because they've done, all these financial arrangements where they're selling stock to buy more Bitcoin, and they're trying to arbitrage that out. That's making it very, in my view, very not just a liquid, dilutive in terms of their earnings. So it's, you can see where I have I have an alert right here at 343.59. It came back above the 50-day. Started to, you started to have this little cheat area, way down here, and then it just rolled over. So there's no idea, there's no way of knowing. It could go to 100. It could go back here to 113 again. There's no reason that, again, when we looked at a lot of these stocks that have dropped 75%, there's no reason that, that any of these stocks could not experience something like that. It's this weekly 55. I think 400. I think it's down 50. It's down 50% or so. But look how, this is again, this is where you make all your money. When it gets tight, it gets tight. You've gone through, this treacherous sideways action, and then finally it gets tight and goes, from this, it goes up, down, up, down, up, down, up, down. And that's what we're waiting for. Just something that looks like this. It doesn't matter to us, or it shouldn't matter to anyone that's trading the market, what the company does or who they do it with. But normally it will be it will be characterized by having explosive earnings, momentum, growth, big moat, barriers to entry, expanding sales margins, return on equity, and it could be it could be a new name that we're not aware of. The power companies, they got on that thing for a while because of the utility and power shortage, particularly with these data centers. But that's, there's the deep seek, and we spent some time talking about this, and in a number of these were the leading stocks. And there's where it appeared they were breaking out to 52-week highs. Your new high list, that's where you want to spend your time. But the new high list is so low right now, and Wes showed that in the chart. Let me see what the new lows were. Yes, we yesterday we had, I think, 4,600 new lows, and now we have 2,100. So that's a this is that's a positive divergence if we go lower in the averages, but the new lows but if the new lows decline, so that'll give you a clue. But look at the new highs, 45 new highs. Golly, gee whiz. In a strong market, you have, you got 2,000 and 3,000 stocks making new highs. Again, there's nothing to buy. 98% new lows, 2% new highs. That is an abysmal market. And you just need time for these things to reverse and to build, their bases. But again, these are the little things that you can watch for to see, if there's no further progress down in new lows, but the averages, make a new low and shake you out. But again, that sometimes takes, 2 to 3 weeks. In the 87 in the 87 crash. And I actually started the week after the 87 crash, and this was there's the Nasdaq. Once you had the crash, it didn't stay down that long. Let's take a look at the Dow. The Dow was more prevalent then. See, this is what right here, guys, this is what this is what we might be going through. See, right, that's, going through the 200-day, and we hit the 200-week. See, again, the 200-week was support, but you just went, you went sideways for it. It just took, up, down, up, down. It was this was very, this just took time. And I think this is what we're in for right here. I think it's, even if we bottom, going through this 200-day, right at the 200-week, I think it's going to be very choppy, going into earnings in the next couple of weeks. The tariff stuff, still not knowing the impact. You got Trump and Navarro, they're fighting, in their respective roles in the government. So this is I think this is what you should be prepared for, unless something, unless Trump has very, very favorable news. And again, the favorable news is if China comes to the negotiating table. But, China, they went on the record today saying that there's no way they're going to negotiate. So who's going to blink first? Who is going to blink first? It's, many economists think that, that we're in a much better position than they are. They need us more than we need them. That's where we are. We're in a bear market. Protect your downside. Don't don't try to make it up. Don't take any major bets until you really, you get some idea that the trend has changed. See, notice here this 10-day below the 21-day the whole time, and it finally, you had the retest of the low, and then it finally you got the trend. The trend turned right here, see? And so the challenge for, for all of us, it's to, it might be just to grab some bench, sit on the sideline and wait, while other people chop themselves up, just wait until you get more clarity on the trend. And again, the trend could change before the news changes. And that's what makes it so ironic and tricky, is that, everybody's talking about the market being a discounting mechanism. And, the headlines can be the worst when the market turns. So, we're not, we certainly understand that, and we're aware of that. And, we don't have to see the news changes first, but the stocks are going to tell you. You can get a bid in the market. You can see the new lows drop, the new highs start to expand. That'll give you the clue to add, potentially add exposure. again, this is what this 200 week, that has been support. That's where, and that's what I'm looking for initially. But are we going to stop here, or we can go through it like 2020? The good thing about what's going on in Washington, though, is, again, what they're doing is, the administration ostensibly is taking, quote, their medicine here right now, early, trying to get all this stuff done. And, remember Trump, how he was mindlessly following the stock market in his last term. Every time he turned around, he's bragging and championing, that he was responsible for it. And, now he's been quiet and resolute that he's not, that he's got more important things to watch than helping the top 10% of Americans make the stock market go up. But all this stuff, I think all this stuff, it's going to be impactful, I think, positively, getting our deficit under control, cutting out a lot of the waste and abuse. It's going to be positive, but there's so much acrimony for the both parties that, it's just, it's hard to listen to. Guys, I think that's all for tonight. Be sure and tune in, follow us on Twitter. We'll help you get through this. If you followed us on Twitter, we got you through, because we got you. We warned you, alerted you to when we were selling and everything. So, we'll continue to do that, but it's just, it's one of these times to go fishing, but, you got to continue to screen, continue to watch and be alert. Jim Roper says it, he says it's beautifully. We're always only 4 days away for a potential turn in the market. The first turn day, then 3 days to the follow through day. And so we're always within, 3 or 4 days of the market turning. And so you want to be doing your work now. And again, you want to be screening the high relative strength stocks and the new high list, which are bare, but they will firm up. But, in the meantime, if you get some of the trend changes, the indexes are a good way of just chipping up anyway. So with that, I'll go ahead and conclude tonight, guys. Thank you for coming. I hope you guys are doing great. Hope you continue to trade efficiently and effectively. And we'll send the recording out with the slide deck tomorrow, so that you can take a look at those charts for your personal research purposes. So guys, thanks for attending tonight. We'll see you next month.
Thank you.
You're welcome.
Great meetup. Thanks a lot, both of you.
Good luck, guys.